Hi, it's David here, CEO and founder of the Freedom Founders Mastermind community. We just completed one of our 3 events, mastermind events that we do each year for our members in the Freedom Founders community. This is the opportunity that we all have to come together as members, but also where we bring the collective genius, the wisdom, the experience of many people from different aspects of the market, the economic market cycle. Certainly we have people in the alternative investment space because that's what we focus on. Yet we are alternatives. Nothing wrong with having money in Wall Street or some money in cash today, but we like the alternative aspects that where we can control, have more proximity to our capital. We have people in different markets that have a lot of experience in the market turns. Myself, not being an economist, but being one who has had his hands on the steering wheel of my own investments for now over 40 years, going back to 1980, I have also gone through multiple major market cycles. I believe we're in one right now. I believe there's something going on that's changing the market. Whether or not you think that we're going into a hard correction, potentially a recession, that's up to you, and many other people have different opinions. But my opinion is, looking at the data, looking at what the leading indicators show, is I believe that we are headed for probably a relatively hard landing, by using some of the Federal Reserve's words, which means that we have some bumpy or choppy waters coming. And I don't think this is going to be a short-term situation. Now, how deep this goes, how much correction we have, again, no one can prognosticate that, but I will say that I believe that we are not going to see a return to the exuberant market that we've had, say, coming out of the Great Financial Recession some 14, 15 years ago now, 2008, 9, 10, where after that downturn and correction, everything came back up again, and we had this flood of monetary and fiscal policy that has really jettisoned the financial and the alternative aspect of market space. So financial markets, stocks, bonds, real estate, Bitcoin, gold, bullion has gone up. Just about everything that you put your hands on, everybody felt like you could do no harm. And for the most part, that was true. Times are changing. And this is what we really dealt on in a big way in our event this weekend. The big concerns and challenges we found were a lot of our members who are in the professional health professions and other businesses where they have their hands on the actual business, have been looking at the exits opportunities, where in the past 2 or 3 years, 4 years, perhaps 5 years, the multiples on business exits, because there's been so much liquidity in the marketplace, have been relatively high. Same thing goes for real estate equities. You could go into a syndication in a multifamily or self-storage or maybe a mobile home park community, whatever it might be, and put your money into a syndication, and within 18, 24 months max, turn a profit, or the operator would turn a profit, and you as the investor would come out and make a nice return on capital. That's what we've seen, and I call that recency bias. The problem today is we're not going to see those same returns. In fact, I would be so bold to say that we're not going to see that kind of profit on the back end of short-term flips. It's really trading on a short-term, relatively short-term basis. It's not going to be there. What we have to focus on today, in my opinion, is operational efficiency, something that is not necessary when we have markets that are trading on it's really a greater fool theory. Someone will always buy my asset at a higher price when we have cheap capital. Well, we no longer have cheap capital. The last 15, 16 months, we've seen a rise of the federal funds rate, which is the benchmark that everything else is based on, going from 0% interest rate, zero, we've been at zero for some time, all the way up to over now 5%, and with the prediction that the Federal Reserve is going to have to push rates up probably another 25, 50 basis points before they even straight line out. A lot of people were thinking, well, the Fed's going to give up the cause, and they're going to go back and lower interest rates by this time this year and reduce their quantitative tightening, which is just another term for reducing the balance sheet debt that has been accumulated over the last several years, primarily with COVID, but even going back to 2008, 9, 10. In my opinion, that's not going to happen, and I won't go into the reasons why. The cause and effect of this, the cause and effect of the rapid, and this is the key thing, the rapid rise of interest rates, not just the nominal rate, well, we're up to 5%. Well, historically, that's not really a high interest rate, David. It really, historically, over the average of the last 40 years, the long-term 30-year fixed mortgage rate has been around 7.75%. Gotcha. Has really no bearing on where we are today. It's the relative rise going from 0 to over 5% that has the cause and effect, and there's a lag effect that we haven't even begun to see the full effects of this. So what does that mean to you? It means for many of you who are looking at taking exits from your businesses right now because of the perceived high multiples on the buyout. Not a sale, but a buyout, meaning you get some of the money up front and some of it later, promised later when there's another recap, refinance in the future. I think you better look hard at those today and make sure that you understand the dynamics of the market cycle and that these promises being made, well, not so much promises, they're forecasts. And forecasts are things that can go awry very quickly. Look hard at those. If you are investing in equities of any kind, stock market equities, real estate equities, I mean, again, you're buying into syndications of some kind that are still buying multifamily, self-storage, mobile home parks, retail. God forbid you're in office right now. That's a mess. But any of those equity participations where we have seen the great rise over the last number of years where, again, everybody made out, better be careful. We look at being more on the debt side. That is not debt as a liability, but owning the debt. Now, one place you can own debt with virtually no risk at all is buying Treasury bills. Yeah, U.S. Treasury bills backed by the U.S. Treasury, the government, the absolute ability for this U.S. government to pay those back. That's paying over 5% today on short-term, 30-day, 60-day, whatever you want to buy. That's paying over 5% today. That's risk-free. You better be getting something stronger than that if you're going to put your capital into asset classes with any kind of risk at all. We do that. We can be on the debt side owning other types of debt that we feel like makes a strong play in this marketplace. My opinion, much safer than equities. Well, David, will there be a time we go back to equities, owning rental properties or Airbnbs if that's what's been your place, which again is another asset class that's on the downfall right now. Yes, there will certainly be a time, but you've got to get through the gap, through the recessionary correction gap before you go back in again. Right now, we're not even close. And so my point is the recency bias that people predict the forecasts on based on linear extrapolation, what we've seen in the past, we should just continue on. Oh, maybe there's a brief pause here, but it's going to continue on. It's like FOMO. Everybody's got to get in on it. And I think that's a big mistake. So my point is, if you don't understand the market cycles, if you haven't studied them, if you don't know somebody who's gone through them, be very, very wary about where you put your capital or when you take equity off the table today, where that's going to go and what the promises are on the back end if you're not getting a full check up front. These are tumultuous times, not times that you should be afraid, but times where you should be more discerning. It's a time where there's going to be another great wealth transfer. Every time we have these major market cycles, a lot of wealth is transferred out of the hands of those who are not positioned well into the hands of those who are positioned well or understand the market dynamics. That's where you want to be. Pay attention, because if you don't, you may be in for some pain and some regret in the future. It's your freedom. Remember, you've got to stay focused on it.